So we're looking at how to do the adjustments, the monthly adjustments for the tabular statement for question 1. So we've laid out the document as we've seen before, all the assets together, all the liabilities together, and we have the same number of assets and liabilities. In the first one here it says Crowley bought a business consisting of the following assets and liabilities. So I put those numbers in there. Okay, so these are the things he got when he bought the new business, and he paid for by giving 150,000 shares in Crowley. So he gave the new person, rather than giving loads of cash, he gave them shares. And he said they were sold at a premium of 10 cents a share. That means they're not, it says on face value they were originally worth €1 each, but because the business has been going for a while, they're actually worth more than that. So that extra amount of money of value, this share premium, we're going to put into a new liability account, which is called share premium account. So share P416. Now, share premium then is going to be 10 cents per share, so it's that number, what the shares were times 10%, so 150 grand. Now remember, all of the assets and all of the liabilities have to add up to be the same. So we had that in the first month, and that has to go the whole way through the whole question. So whatever changes we make in the assets have to give us result in the same changes in the liabilities. So this formula that I'm copying across is the figure I got when I added up all of my assets and all of my liabilities before. Now we notice that these two figures don't agree at the moment. So he paid 165 for something that was worth less than that. Now there's 170,000 of assets minus 20,000 creditors. So the business that he paid for was worth 150,000. 170,000 of assets, 20,000 liabilities. So the business was worth 150. But he gave something, not cash, but he gave some shares which were worth 165,000. So you actually paid more than it was worth. And the extra money that you pay for something, you're paying for the other business's reputation. So that's actually called goodwill. So you're paying 15 grand extra. So we call that goodwill. Okay, next one. He sold goods and credit that cost 2.4. The selling price is markup on cost of 25%. So markup, so we understand, is the extra that's added onto this, what something costs to come up with the selling price. Okay, so I'm just going to put this down here. So we have cost plus profit equals sales price. So this thing cost 100%. We're adding on to that 25% profit, it says, and that means 125% is its selling price. Okay, so those goods cost 2.4. Okay, the selling price is markup of that, so that means this number multiplied by 25%. It gives us our profit, so our sales price is when we add these two together. Okay, so let's think how that's going to affect this now. So our stock, so this is the goods sitting on the shelves, are going to go down by 2.4. So let's put a minus there, so minus 2.4, so we have 2.4 less in stock. Our debtors, now it does say we were sold on credit, so therefore our debtors owe us 3 grand more. And that means that we made €600 profit, and the extra money that we made is going to go into profit and loss balance. The above goods were returned and a restocking charge of 5% was applied. Okay, so that means that we now have those goods back in stock, so 2.4 is added back on, so it's a plus. Okay, now our debtors, those debtors, they owe us 3 grand less, but we also have the restocking charge taken into account. So we're going to take 3 grand away from our debtors, and we're going to add on our restocking charge. And the restocking charge is 5% of what we sold the stuff for. Okay, so we're adding on to them 3 grand, because that's what we sold them for, times 0.05, that's 5%. Okay. So we're going to take 2,850 away from our debtors. So that means that we're going to, down here my profit and loss balance, I'm going to lose out on €600 worth of profit, okay, but I'm going to gain, I'm going to have an income of a restocking charge because I'm charging this to somebody else. And the net effect, so again, we're just looking to double check, the net effect on all the assets and liabilities is the same, so that means I'm doing the question correct. So we're looking at motor vehicles that were traded in. So I have a motor vehicle that costs 36 trading against a new vehicle costs 45. So that means in my motor vehicles account, I'm going to have 36 taken out, and I'm going to add in the 45 for the new one. The amount paid by check after allowing for the old vehicle was 12. So that means I wrote a check for 12 grand, and that's a minus in bank. The depreciation date on the old vehicle was 20. So that means during all the years I owned it, included in this minus 26 was 20 grand for this particular one that I got rid of. So I'm going to take that 20 out of provision so that I can put it into a disposal account. Okay. So to get, this is a minus 26. So to take away from that minus 26 the 20 that I have depreciated over all the years, that actually becomes a plus number. I'm taking something away from a minus, so it becomes a plus. So the net effect then is I have 17 grand more assets, and that has to be explained by the fact that if I had done a disposal account, I have made a profit of 17 on the thing that I sold. So that profit is plus. Okay, it's added to my profit and loss balance. So just so we work out in our heads, how did this happen? So we had the cost of the vehicle was 36. It's the provision for depreciation was 20. Okay, so that's the depreciation that I'd written off on it over all the years that I'd owned it. So that means that the thing was worth 36 minus 20. So the thing was worth 16. Sorry, I got the maths wrong on that. So 36 minus 20 is 16. So that's what its book value was. We kind of call it net book value. That's what they would have said in the leave insert or in the question. But they gave us a trade-in. Trade-in, which must have been more than that. Now, how did we work out how much they gave us as a trade-in? So it says the amount paid by check after allowing for the old van was 12. So that means we gave the old van plus 12 grand to buy something worth 45. So the trade-in must have been 45 minus the 12 grand. So they gave us 33 grand of a trade-in against something that was worth 16. So therefore we made a profit. We got more than it was worth. So we made a profit of 17 grand. So that's where that number there came from. Moving on. We issued 50,000 ordinary shares at €1.20 each. So that's ordinary share capital again. So we have 50,000 more shares. That's added on. And we issue them at 1.20 each. That means we issued them, people paid 20 cents more than they were worth. Okay, so the money that came into the bank was the 50 grand. So we have a plus in the bank, 50 grand multiplied by 1.20. Okay, so that means we received 60 grand in cash. So therefore we received an extra 10 grand in share premium. So share premium, which already has 15 from a previous month. So we have 10 grand extra. So now we still have the same number of assets and liabilities. And sometimes, like we had in the previous month thing, sometimes the missing figure is found when you realize that the assets, the change in assets and the change in liabilities must be the same. Next one, land and buildings are revalued at 800 grand. So land and buildings at the moment is worth 500 plus 140 for the new vehicle business that we've bought. So that means they're worth 640, but we're revaluing them. We're saying that they're worth more, so we're going to add on 160 to the value of the land and buildings to make them 800. So that means our assets have gone up by 160, which means the money that the shareholders have invested in the business also goes up. When we create a new liability called a revaluation reserve. So the buildings are worth more, so therefore the money the shareholders have put into the business is also worth more, and we'll have this new reserve which is going to handle that 160 grand of increase in value. Now next, received a bank statement showing credit transfer for rent received of 2,400 for the year ended 31st of the 5th 2007. So that's taking me into next year. So that means that there must be a prepaid. Now I've got a bank statement, so I have received rent, which is a plus in my profit, and obviously I've received money into the bank, so 2,400. So I just put 2,400 into the bank first. Now we've seen these before. So this 2,400, not all of, if that 2,400 was money we received, we would add that to our profit because it would be an income. Rent received as an income, but we didn't receive all of that we haven't used up or allowed our tenants to use up all of that 2,400. So that means we owe our tenants the use of the building for a period of time next year. So that's a liability. So this is a prepaid of an income. So an income, remember, is rent. So remember, rent is an income. If we receive too much income that hasn't been used up yet this year, we owe that, we're the landlord, we owe that back to our tenants next year. So how do we decide to divide this 2,400 between the amount that's going to be income of this year, which goes into profit and loss, and the amount that will be a prepaid, which goes into next year? Well, it's done based on the number of months. This credit transfer is for a year, it says, okay. The rent received for the year ended 31st of the 5th. So therefore 5 months or 5/12ths of the 2,400 is going to be a prepaid. So prepaid is going to be the 2,400 multiplied by 5 divided by 12. So 1,000 is prepaid for next year. So that means we must have an income of 1,400 this year. And that adds up to 2,400, so that's correct. Lastly, paid the ordinary shareholders a dividend of 10 cents per share. So how many shares have we issued? We have 150,000 shares initially, plus another, 500,000 initially, plus 150, plus another 500. So that means we've got a total of 700,000 shares issued. And that's going to be in my total column at the end. So 700,000, and they're going to get 10 cents per share. So that means from bank, I'm going to pay out 700,000 multiplied by 0.1. Okay, so I'm going to pay out 70,000, and that means my profit and loss balance. So this is an expense. When I pay dividends, it's an expense of the business. So I have the same figure as a minus in my profit and loss balance. So that adds up to be the same. So that's dealing with all of those monthly adjustments. And then to finish up the question, this is the bit that can be tedious and takes a long time. What you do is you add along all of the months, and so we started off, for example, here with land and buildings. So the figure we had at the beginning, we add everything all the way along to the figure we had in the last month. Okay, so we have 800,000, and we did the same for all of our months. And this is the thing that will take you time. Obviously, it's a little bit quicker for me with the computer. So you add up all of those. So I've added everything all the way along the row in each case. And I do the same thing down here for all my liabilities, starting with that one, all the way down to there. And if you've done the question correctly, you should end up with the same figure in both, okay, in the totals of both.